Today, we're diving into cash out refinances, what they are, how to qualify, what they cost, and when they might make sense. If you've got equity in your home and want to tap into it or are considering ways to use that cash, this one's for you. So, what is a cash out refinance and how does it work? A cash out refinance is a way to replace your existing mortgage with a new, larger loan. You use that new loan to pay off your old mortgage, and you get the difference in cash at closing. For example, if your home is worth more now than when you bought it, and you still owe a smaller amount, the difference minus what the lender allows based on your home's value is yours to keep. It's often used when homeowners want to consolidate high interest debt, make home improvements, or for other large expenses, because mortgage interest tends to be lower than what you'd pay on unsecured debt like credit cards. However, there are trade-offs. The interest rate on a cash out refinance is usually higher than for a refinance where you don't take any cash back. Also, you'll have a bigger loan balance, which means more interest over time. So it's important to run the numbers to make sure the benefit of getting the cash out outweighs the extra costs. What are the typical requirements for getting approved for a cash out refinance? Well, to qualify for a cash out refinance, especially with a conventional loan, you'll typically need more than 20% equity in your home. Lenders want to make sure that enough of the home's value remains in the home after the refinance. And a home appraisal to confirm how much your property is worth now. That determines what 80% LTV means in terms of dollars. And a credit score of 620 or better for conventional loans. Now, FHA and VA cash outs have different, often slightly lower minimums, but also a debt to income ratio or DTI that isn't too high. Commonly, no more than about 43% once the new mortgage is included. And you'll need proof of stable income and employment and acceptable overall financial health. Now, how much cash can I actually get with a cash out refinance? Well, with conventional cash out refinance, most lenders allow you to borrow up to 80% of your home's value. Then you should subtract what you still owe on the existing mortgage to figure out what you can receive in cash. So for example, say your home is worth $400,000 and 80% of that is $320,000. If you still owe $250,000, then $70,000 might be available for cash out. But be aware, existing second mortgages, home equity lines of credits or HELOCs, or home equity loans also reduce how much free equity you really have because their balances usually get subtracted from the calculation. Now, how do interest rates compare for cash out versus standard refinance? Rates for cash out refinances are typically higher than standard refinances where you don't pull out cash. The article states cash out rates tend to run about 0.125% to 0.5% higher than no cash out refinances. Now, what influences your rate? Your credit score, especially if it's over 740. How much of your home's value you want to borrow, your loan to value ratio, and how much equity you're tapping into. The more risk the lender takes, high LTV, large cash out, lower credit score, the higher your rate tends to be. Now, what types of cash out refinance loans are there and how do they differ? Yeah, there are three major types. One, conventional cash out refinance. As mentioned, typically allows up to about 80% loan to value, a credit score of around 620 or higher, and typically has lower costs compared to government-insured options for many borrowers. It's usually the best when your financial profile is strong. FHA cash out refinance, now this tends to be more accessible for borrowers who don't qualify for conventional because they may have lower credit scores or less equity. These loans usually require you to pay upfront and annual mortgage insurance premiums. Now, VA cash out refinance are for eligible veterans, active duty, and certain spouses. VA cash out can allow very high loan to value, up to 100% in some cases, although many lenders limit it to 90%. but you'll typically pay a VA funding fee unless you're exempt, for example, due to service-connected disability. Now, each option has trade-offs in terms of cost, upfront fees, insurance or funding fees, and how much equity you can access. So choosing the right one depends on your situation. Now, what does the closing process look like and how long will it take to get the cash? The process for a cash out refinance is similar to a regular mortgage refinance, but with a few extra steps. You'll compare rates from lenders, submit a refinance application, provide documents like pay stubs and W-2s, get your home appraised so the lender can verify its current value, and go through underwriting and then close. As for timing, in a normal mortgage market, it might take about 30 days from application to closing. But as of mid-2025, because many homeowners are interested in refinancing and because lenders are busy, cash out refinance closing often takes 45 to 60 days. So plan accordingly if you need the cash by a certain date. Now, is a cash out refinance generally a good idea, and when might it not be? It can be a good idea under certain circumstances. If you can get a lower interest rate compared to what you're currently paying, if you want to switch from an adjustable rate mortgage to a fixed rate one, and if you're consolidating high interest debt, or if you want to do home improvements that increase your home's value. It gives you cash at closing that can be used for important expenses, but it might not be the best choice in some cases. So for example, if you're borrowing just for wants rather than needs, like vacations, for example, if the interest rate is significantly higher or if closing costs are high and you might not live in the home long enough to see the benefit. Also, using that cash without a plan, it can make things worse. So bottom line, a cash out refinance is a powerful tool if you have good equity, decent credit, and a solid use for the money. But because rates can be higher and costs are involved, it's crucial to compare all of your options and make sure the benefits outweigh the costs. If you like this breakdown, hit the like and subscribe for more mortgage and home financing tips.